This video is a basic introduction to investing. Investing is basically putting forth some money in some asset class with the expectation of getting returns on the principal, which is the initial amount invested. An asset is a valuable item owned by someone or some entity. There are various asset classes, out of which we are going to cater to stocks, mutual funds, ETFs, cryptocurrencies, real estate, gold, bonds, and FDs. Investing is important. The money that we save, we can invest a part of that money in one or more of these asset classes to earn passive income. Just the knowledge about various investment options, how to analyze them, the risks associated with them, and the potential return they can provide can help open a new income stream and boost our earning by multiple folds. Investing wisely with all this knowledge is important. Otherwise, there is a risk of losing all the hard earned money invested. Not investing the money would cause the value of the money to decrease over time due to inflation. Inflation is basically the rise in the general price levels of products and services, because of which they become expensive. For example, if there is a 5% inflation rate, then an object which costs 100 bucks today would cost an estimated 105 bucks the next year. But if we do not invest our savings and choose to keep them idle, our 100 bucks would not increase. So the money with us will lose value. Hence, it is essential to invest the money in appropriate asset classes to generate wealth instead of keeping the money idle. Diversification is an important concept in investing. Just like we say don't put all your eggs in one basket, it is advisable to not put all your money in the same asset class. One should diversify his or her investment portfolio by investing the money in various asset classes. Through diversification, we can balance the risk and return across different asset classes. There could be various reasons for investing. Investing for the short term could help accomplish short term goals, for example, buying a car. And investing for the long term can help fulfill long term goals like buying a house or creating a retirement corpus, which would allow one to live life comfortably after retirement without facing any financial constraint. But one should be aware of his or her objective of making investments, whether one wants to invest his or her money safely in order to just protect it against inflation, or one wants to grow his or her money at a faster rate. It also depends on a person's risk appetite or risk profile, which is basically how much risk a person can take in making investments. Usually, higher the risk, higher the returns. There are two ways of making investments in general. The first one being lump sum investment. A lump sum investment is where a person makes a heavy one time investment. It could also prove to be very risky. This is because the payment is done all at once. So, if the investment was made when the asset class was trading at a high, then it would result in a loss or a significant reduction in the returns. But if lump sum investment is done at the appropriate time, then it can prove to be highly profitable. This is because if the lump sum payment was done when the asset class was trading at a low, then it can help generate massive returns. So the timing of the investment is crucial when making a lump sum investment. One should try to invest at a lower amount and sell at a higher amount in order to generate huge returns. An example of the same is that during the times of COVID lockdown, as clearly evident in the graph, the stock market had crashed, and the people who had done lump sum investments in good stocks during that time, they would have already received massive returns since then. The other type of investment is SIP. SIP stands for Systematic Investment Plan, where one invests a certain amount of money at each decided time interval, which is usually a month. The prices of almost all the asset classes change, so when investing through an SIP, sometimes the money would be invested when the asset class is overpriced. Sometimes the asset class would be a little underpriced. This would help average the cost at which we are able to buy it. It significantly reduces the risk of investing in any asset class when it is overpriced. So it basically helps balance the risk and return. Both forms of investment can be used. One should continue to invest through his or her savings in the form of an SIP, and when they believe that the investment could be made at a discounted price, meaning it is available at quite a low price, then the person can invest in a lump sum amount of money through which he or she would be able to earn a massive return on that lump sum investment. If we keep waiting for the price of the investment option to fall significantly in order to invest a lump sum amount, it is possible that the price might never fall that much. Thank you for watching this video. I hope that you were able to gain valuable information about investing.